crypto's institutional lending market and what we can expect. Thank you.
Thank you. Good afternoon, everyone. Welcome to today's panel on crypto's institutional lending market with Leeor Groen from Spartan Group and myself. My name is Jamie Knowles. I work at Galaxy on the institutional sales desk in London. Galaxy are a global financial services and tech firm focused on blockchain and digital assets that was founded by Mike Novogratz in 2018. We have a variety of different business lines that include asset management, investment banking, mining, protocol solutions, venture capital, and global markets. Within the global markets area where I sit, we are one of the largest OTC liquidity spot providers and derivatives providers, and we also run one of the largest OTC lending desks still within crypto. Our lending business specifically focuses on how can we help our clients gain responsible leverage and capital efficiency on their digital assets and crypto holdings, and also their cash holdings. And within that, we also look to provide various solutions such as margin lending, collar loans, specialty lending, and revolving credit facilities. And finally, for context, our clients include trading firms, hedge funds, both crypto native and TradFi, high net worth individuals, family offices, and VC firms. With that, I hand over to my co-speaker, Leeor, for an introduction.
Thank you very much, and pleasure to be here, everyone. So thank you for taking the time to talk about probably one of the most exciting areas in this industry at that point in time. By way of context and background, my name's Leeor Groen. I'm originally from Australia. I've spent the last 10 years between Europe and Asia working at the intersection of finance and tech. Got into the blockchain space, have been full-time entrenched in this industry since 2016. So as much as I would like to say that the occurrences over the last 24 months are standout and unique to themselves, I can say I've been through this before, and a lot of the things that we're seeing, unfortunately, are not new. Which is exactly why, frankly speaking, we at Spartan Group are really in this industry with a long-term perspective of being a strategic and trusted platform for operators in this space. So for those of you not familiar with Spartan Group, we're founded in Asia with our offices between Singapore and Hong Kong in 2017 by 3 former Goldman partners. I think nowadays that probably is a more common occurrence, but at that time certainly was a big step moving into this industry and really being associated with what was an emerging space around crypto. At Spartan specifically, we do 2 things. So we have our asset management arm and deal-making activities. So across our asset management business, we are running a liquid hedge fund. So we're one of the first institutional asset managers out of Asia, which has a 4+ year track record investing into digital asset space. We run 2 venture funds, one focused on DeFi, which is certainly the area of interest when we look at empowering and backing many of the entrepreneurs who are working within the lending space, and also actively investing in the gaming, metaverse, and NFT opportunity set, let's say. In addition to that, we're one of the most active dedicated deal-making advisory groups, similar to Galaxy. We collaborate with them on many ways. And pleasure to be here to talk more about specifically our topic today.
Fantastic, thank you, Leeor. So when I look at the crypto landscape over the last year, one of the key areas that has changed the most has been on the institutional lending side. I think maybe a good place to start for the audience today would be just a little bit of context around where we've come from, what's happened, and where we are today.
Yeah, so I guess I can give a brief summary of at least what I think is the last 24 months. So I won't go back too far into ancient history, which tends to be the case in crypto. So 2 years is already plenty. But frankly speaking, right, I think what was a market that's emerged from nowhere. So, I mean, institutional lending in crypto didn't exist 2 years ago either. What we saw happen in a meaningful way and evolve, right, through the bull market of 2021 was an engagement and willingness of people to start using either collateralized or uncollateralized lending products and solutions. Now, in more stable financial markets, this is obviously a known and trusted practice, which is basically the crux of value in the financial system. So if you look at, ECM versus so equity capital markets versus debt, and instruments linked to debt, it's a much larger amount of value, which is on the credit side of the industry. So people looking at crypto got excited about that prospect of, yes, spot is interesting, yes, derivatives trading is interesting, but how can we get more leverage, more margin into the system and create, obviously, what was a very attractive snowball that came through for a lot of people who were profiting from that, and equally fast in the last 12 months specifically, filling the other side of that in terms of boom-bust cycles, right? And my point here would be, make no mistake, right? This is not a failure of crypto. This is not a failure of our ecosystem. This is a failure of actors within our ecosystem who were making decisions. And the point that I'd always like to reiterate, and why we're so bullish about credit markets within crypto still, is because technologically speaking, we haven't seen things implode, right? If we look at many of the large-scale protocols who have gone out to establish foundations and principles by which people can participate in DeFi, participate in borrowing and lending pools, these things have all stood the test of time despite collapsing market prices, collapsing token prices within those governance protocols, and these things are still standing strong. What we have seen, obviously, is an abuse of goodwill, a sufficient amount of fraud, and I won't go into too much speculation on things which are happening in real time, but actors within our industry who likely will see criminal charges and deal with those consequences is a function of the human nature of this industry. So when people talk about what happened in a nutshell, right, long story short, is we got carried away, right?
Too much leverage.
People got carried away, and now it's about bringing that back down and focusing on what actually matters. But how have you guys seen that at Galaxy?
Yeah, so first of all, completely agree with all your comments there. So, the two key buzzwords at the moment, or from the last 12 months, have been too much leverage and counterparty risk. So when I look at how the lending market has changed over the last year, it's really unsurprisingly seen a big dry up. Institutional loans on a notional basis have had a significant drawdown from last year. And that's really, firstly understandable, just given what the market has done, and also due to some key changes in market structure, both on the demand side and on the supply side. So on the demand side, first of all, clearly we've had some of the biggest players within borrowing are no longer available. So, guys like 3AC, Alameda, they're no longer in the market. And naturally, just because of what the market has done and the turbulence from last year, a lot of the main borrowers, such as crypto hedge funds, trading firms within digital assets, they've either pulled back risk significantly or they're no longer in business. So the borrow side of the equation has pulled back significantly. On the supply side as well, unsurprisingly, loads of potential lenders, or loads of previous lenders are no longer in business. So guys like Celsius, Voyager, BlockFi, Genesis, they are no longer around. And the key thing is that lenders that were still standing, they had been significantly worried about counterparty risk and had pulled back significantly towards the back end of last year. There just really was no willingness to sort of lend, and the collateralization levels that people wanted went really through the roof. And that's really a key thing to focus on as well in this conversation, because really what drove the huge amounts of leverage last year was the ability of firms to gain access to unsecured borrow effectively. So the ability to borrow $1 without having to put down any collateral. And unsurprisingly, that was what built leverage upon leverage. And when that was unwound, there was no ability to digest that. So what's happened now is that the market has swung the other way, where lenders now want too much collateral. So things are over collateralized. So now lenders are wanting anywhere between 130 to 150% collateralization levels, potentially sometimes even more. And people in the market really just aren't willing to pay that. So there's a big spread in the amount that borrowers are willing to pay versus the amount that the amount that lenders are potentially looking to charge at the moment. And on that point, it's probably, like I was saying, counterparty risk is the big thing that people are talking about. From your perspective, trust and counterparty risk, how can we look to rebuild trust, within institutional lending? What are your thoughts at Spartan around that topic?
Yeah, so I agree with everything that's been said, and this topic of counterparty risk is something that is so new in this industry, and that is problematic in and of itself. Like, why were people not asking questions, going through a diligence process with a counterparty for any kind of formal relationship? The emphasis in this industry on the prior years has always been around compliance and ticking boxes on a sheet, right? And I think as we as an industry mature and become much more sophisticated in the way in which we're transacting with each other, with people, through protocols, through direct counterparty relationships, these are things that have not caught up. So those processes have not caught up, but the size and scale of the transactions that were happening, we're talking about billions and multi-billion-dollar deals going through here. Now, anyone who's worked in compliance or in the TradFi world understands for people to be able to lend those size of amounts of money, the diligence process to onboard a new counterparty, even to get a home loan, right? I mean, as a retail citizen, I mean, you know how difficult that can be. And we're talking about checklists within our industry that was probably easier to get than a mortgage, right? And I think that this is some of the problems that have been flushed out of the industry now, and where we're really focusing on at Spartan, I mean, through our venture fund specifically, as big believers in DeFi, the crypto native element of a protocol-based seamless technological layer for transacting with people. The credit markets is a key part of that market infrastructure of the future. Specifically where we've focused our time on, I mean, has been backing entrepreneurs in this space. And two of the companies that I would mention within our portfolio who are solving specific elements of that market infrastructure of the future. Again, shameless plug, so we're invested, please don't, not financial advice, but referencing, of course, some of the things that we're seeing is specifically one organization, Credora, which has come forward and built one of the first frameworks for evaluating counterparty risk. Now, that sounds like such a basic thing to have had, but our industry has not had that. So there's been no standardization of what is diligence in a process, who is the person I'm taking money from, and how many other people are they also taking money from. I think these fundamental questions, and we can go into what that means and looks like in practice when we're enabling that through on-chain governance and metrics, but the basic proposition is I'm actually asking you questions and going through that process to identify a counterparty risk and having a way to evaluate that. So that's step one. I think once you have a basic functioning level of a marketplace or an infrastructure which is saying these are the counterparties and you know who you're engaging with, the way in which you're actually executing those transactions, how do you enable that? And that's where we're really seeing, I mean, one of our other portfolio companies, which we're very excited about, is an organization called Celeste. I mean, they are creating a debt liquidity hub for people to be able to borrow and lend, institutions to be able to borrow and lend, and actually transact with each other through a marketplace-like function where you're able to see who else is in the market and doing this, right? And I think all of these things are so intuitive within the crypto ecosystem. On the spot, on the trading side, everyone can go and actually transact with each other, but no one's actually built that infrastructure to happen in what is already a very global industry, cross-border. Everything we do is cross-border, but people operate very differently. So connecting all of those pieces of the puzzle together is one, evaluating counterparty risk, two, having a foundation for people to able to transact and borrow and lend with each other. These are the critical infrastructure pieces that will be the foundation of what we consider DeFi 2.0 or crypto infrastructure in the lending space 2.0, which will be the next wave of growth. I mean, is that something that you guys recognize and can relate to?
Yeah, completely agree again with all those points. I think from our perspective on the OTC side, a couple of things needed to bring back, well, certainly counterparty trust and demand. First of all, you've got some top-down and bottom-up drivers. So from the top-down perspective, first of all, to actually drive demand, we need to see one, first of all, time. Time is needed to heal what's happened in the market. It's only been 3 or 4 months since some of these big unwinds, and I think some of the scar tissue there is still fairly fresh. The second thing is really just more market volatility as well. So one of the issues why the borrowing lending market dried up significantly at the back end of last year was just market went sideways. If you guys look at the price of Bitcoin, it traded in a fairly static range for multiple months, and there was just no incentive for borrowers to borrow and lenders to lend. But that's driving demand. On the counterparty side, trust specifically, it's really down to 4 things. One is really understanding who you're lending to. So that goes back to old school fashioned risk management around, understanding the client, consistent calls around, what their equity is, what their NAV is, what sort of assets they're holding, etc. The second bit is really around infrastructure, like you said, being able to, in real time, look through and understand what type of assets clients are holding and the type of quality or collateral that they're holding. And something that we've talked about, you and I, has been the ability to use ZK technology to look through, monitor and evaluate in real time client assets without having to give away privacy. So those are some of the main things that we're looking at Galaxy. Also as well, we have some, there are other sort of third-party services that include things like insurance and syndication, which, as the loan market comes back, we'll hope to make it a little bit easier on the risk side. On a longer-term basis, one of the areas that we are quite excited about is tokenization and the type of collateral that people are going to use. Certainly, collateral has a variety of different sources, but Bitcoin and ETH clearly are higher quality, but people have been using collateral in the past, things such as FTT, which had been deemed as lower quality. So over time, we hope that tokenization of fixed assets, such as treasuries, etc., will allow crypto companies, on the borrowing lending side, to be able to hold assets that we deem are of higher quality, which will lead to sort of more secure borrowing lending markets. One of the key things I wanted to talk to you about today, Leeor, was on the DeFi side, just given the pullback in institutional lending, there's clearly been a big shift towards people borrowing and lending on DeFi. What are sort of the themes and trends that you guys are thinking about with respect to that at Spartan Group?
Yeah, no, I mean, I think it's certainly an area which is basically still at its infancy, right? If we think about the level of activity that's happening in crypto lending markets today, even if there has been a pullback and interest resurging on the DeFi side, this is still, immaterial in the scheme of where we are on traditional financial markets and where this has the potential to go. So, I mean, obviously players like Aave, which are, pretty much entrenched in the industry at this point, everyone understands the basic principle, that's possible there, contributing to a pool. And how we look at this, right, and the reason why I'm actually so bullish on the opportunity set on the credit side, many of the issues that have come by, if we consider fintech and this whole notion of peer-to-peer lending, a lot of these opportunities are not born overnight. These are ideas and concepts that have been implicit within the financial industry for so long, and entrepreneurs have been trying to validate what's possible. I think the enabler and why crypto is such a prime position to actually implement and realize a lot of these opportunities is this idea of the composability of liquidity. So you can move, once on chain, you can move your assets from pool to pool, from area to area, and be that spot trading, leverage, and used as collateral to trade on, provide margin for, or lend against an asset. This money going onto the system and being present and transacting throughout is certainly an opportunity set that, for us, frankly, is one of the key enablers for unlocking huge amounts of interest of assets flowing into this space and being relevant. I think the reality that we have today and some of the challenges in getting there is when we talk about the traditional, TradFi players coming into crypto, who's being a part of this and what are they doing? Most of these people still don't have the infrastructure to be able to engage in USDC or USDT denominated, stablecoin denominated transactions, let alone talking about taking Bitcoin or ETH as collateral, which crypto native players would consider blue chip. For a traditional financial institution is, I can't even hold USDC, so how am I getting this composability factor of my liquidity to be able to operate throughout the system? So it's a bit this chicken and egg situation where everyone's sitting around the room waiting for TradFi to come in and not save the day, but certainly come back in a meaningful way to show interest in this space. But at the same time, the basic infrastructure allowing for them to participate, and I'm not going to start talking about regulation and bore everyone here, but that is certainly one of the missing pieces of the puzzle as well that we need to get on top of and allow for these TradFi players to actually participate in this in a meaningful way, not just through subsidiary and side activities.
Absolutely, and just in the interest of time, I definitely foresee a future whereby OTC lending and DeFi lending for institutional clients will be able to coexist. But with that, in the interest of time, thank you very much, everyone, and appreciate your attendance today.